What if I told you that the price you see on your chart is only half of the story? Every day, millions of traders watch candles move up and down, trying to predict the next market move. They focus on patterns, indicators, support, resistance, and trend lines. But there's one piece of information that separates experienced professionals from average retail traders. Volume. Price tells you what happened. Volume tells you why it happened. If you ignore volume, you're trading with only half the information available. In today's video, you'll learn how professional traders read volume the right way, not through complicated indicators, but by understanding the relationship between price and participation. We'll cover 3 essential concepts: why price and volume must always be analyzed together, the powerful effort versus result principle, 3 volume patterns that often reveal what smart money is doing before everyone else notices. Let's begin. Part 1. Price versus volume. Understanding the difference. Imagine you're watching an auction. A painting is worth $10,000. If only 2 people are bidding, the price might slowly rise. But if 200 wealthy collectors compete for the same painting, the price can explode within seconds. The final price matters, but the number of people competing tells you how strong the demand really was. The stock market works the same way. Price is simply the result. Volume measures participation. It tells you how many shares changed hands during a specific period. Without volume, price movement lacks important context. Example 1. Suppose stock A rises 5% today. Looks bullish, right? Now, imagine only a small number of shares were traded. That means very few market participants supported the move. Tomorrow, that entire gain could disappear. Now, consider another stock that also rises 5%. But this time, volume is 3 times higher than average. Large institutions, hedge funds, pension funds, and professional traders are participating. That move carries much more credibility. Same price movement, completely different meaning. Why institutions care about volume? Retail traders often think institutions move markets because they have more money. That's true. But institutions also leave footprints. When a hedge fund buys millions of shares, they cannot hide their activity. Large orders create abnormal volume. This is why professional traders don't chase price. They watch where unusual volume appears. Volume often reveals institutional interest before the trend becomes obvious. Case study. Imagine company XYZ reports stronger than expected earnings. The stock gaps higher. Many beginners immediately buy because price is rising. Professional traders ask another question first. Is today's volume significantly higher than normal? If volume is weak, the move may simply be emotional buying. If volume is exceptionally strong, the breakout has much higher odds of continuing. Price tells the story. Volume confirms whether the story is believable. Part 2. Effort versus result. The professional mindset. Now, let's discuss one of the most powerful concepts in volume analysis. Effort versus result. Think about pushing a heavy car. If 10 people push together, the car should move easily. Large effort. Large result. That makes sense. But imagine 10 people push with all their strength, and the car barely moves. Now something is wrong. The effort was large, the result was small. Markets behave exactly the same way. Volume represents effort. Price movement represents result. Professional traders constantly compare these two. Scenario 1. High volume, large bullish candle, strong price advance. This tells us buyers were aggressive and successful. Effort matches result. Healthy trend. Scenario 2. Very high volume, tiny candle, little price movement, huge effort, very small result. This often means strong buying is meeting equally strong selling. Someone is absorbing orders. Large players may be distributing shares. This can become an early warning sign. Scenario 3. Huge volume. Price suddenly reverses. Why? Because after aggressive buying, professional sellers stepped in. Retail traders were excited. Institutions were selling into that excitement. Understanding this relationship changes how you interpret charts forever. Real market example. During major rallies in companies like Nvidia, Apple, or Tesla, you will often notice periods where volume explodes, but price barely advances. Many beginners think, more volume means buy. Professionals ask, if buying is so strong, why isn't price moving higher? That single question often separates disciplined traders from emotional traders. Part 3. 3. Critical volume patterns. Now let's learn 3 important volume patterns every trader should recognize. Pattern 1. Stopping volume. Imagine a stock has been falling for weeks. Fear is everywhere. News is negative. Retail traders panic. Suddenly, one trading session produces enormous volume. Price drops sharply. But buyers quickly step in. The stock closes well above the day's lows. This is called stopping volume. Why? Because aggressive selling was finally absorbed. Large institutions were willing to buy everything frightened traders wanted to sell. The downtrend begins losing momentum. Stopping volume doesn't guarantee an immediate reversal, but it often signals that selling pressure is becoming exhausted. Example. A stock falls from $120 to $80. Everyone expects lower prices. One-day volume becomes 4 times normal. Price touches $75, then closes at $82. That tells us buyers absorbed massive selling pressure. This deserves attention. Pattern 2. Buying climax. Buying climaxes usually occur near the end of strong uptrends. Everything looks perfect. Financial media is extremely bullish. Social media is full of optimism. Retail traders rush to buy. Then something interesting happens. Volume reaches the highest level in weeks, but price stops making meaningful progress. Sometimes the candle even closes lower. Why? Because institutions may be selling into public enthusiasm. Demand is still present, but professional money is exiting. This often appears before corrections. Not every buying climax ends the trend immediately, but ignoring it can be expensive. Historical example. Many historic market tops showed extraordinary buying volume right before momentum slowed. The excitement reached its highest level, exactly when professional investors were reducing positions. The crowd was buying. Smart money was distributing. Pattern 3. Volume divergence. Volume divergence happens when price and volume stop agreeing. Example 1. Price continues making new highs. Volume becomes weaker each rally. Momentum is fading. Fewer buyers are supporting higher prices. Trend strength may be weakening. Example 2. Price continues falling. Volume becomes smaller each decline. Selling pressure is disappearing. The downtrend could be approaching exhaustion. Volume divergence doesn't predict exact turning points. Instead, it warns traders that market conditions are changing. Professional trading is about recognizing probabilities, not predicting certainty. Putting everything together. Let's combine everything